Now let's look at earnings per share. Earnings per share is one of the most common, most useful ratios for analysts of any nature, whether it be just an average person looking at companies and their stock, or professional analysts. They all use earnings per share. And basically it tells you what it is. It's earnings, meaning profit, divided by the number of shares, and that's exactly what the ratio shows you. Earnings divided by the number of shares. Notice we do take out the preferred dividends, and the reason for that is because preferred dividends go to preferred stockholders straight out of net income, and common shareholders will never see that. So we need to take that out since they'll never see it. So you take the net income per share, the profit per share, the earnings per share. So let's look at the problem. Kalen Corporation had in 2025 net income of $1 million. They paid dividends of $2 per share to their preferred stockholder. And then during 2025, they had 250,000 shares of common stock. So to calculate the earnings per share, I'm going to take the net income, $1 million, and subtract the preferred dividends. They said the preferred dividends were $2 on 100,000 shares, so that's 200,000. So I take $1 million minus the 200,000 and divide by the number of shares, and we get $3.20 per share. So this problem is very straightforward. So here's our problem where we're going to have to make the calculation using a weighted average for the number of shares. So Lennon Industries has stock outstanding as follows. So it has common stock and it has preferred stock. So the preferred stock, we need to remove that dividend. 6% times $100 is $6 per share times 10,000 shares. So we know that the preferred dividend is going to be 60,000. Then we also had additional acquisitions of shares. So April 1st, the shares were issued they issued 50,000 shares. Then they issued 80,000, and then they issued 30,000. So there's different amounts of shares outstanding throughout the year. They realized a $90,000 gain on discontinued operations. So this is going to be important. So notice that it's a $90,000 gain on discontinued operations, and that there's a 20% tax rate. So first of all, what we want to do is we want to show the income from continued operations separate from discontinued operations. We also want to show the earnings per share for continued operations separate from discontinued operations. So we're going to break out the discontinued operations. So they said that our discontinued operations were 90,000, but we want to net the taxes. So since it's a 20% tax rate, that means that $18,000 would be the tax impact of the discontinued operations gains. So we would have to pay $18,000 more taxes. So instead of getting $90,000 gain from discontinued operations, we would only get $72,000. So our total net income then would be $300,000 plus the $72,000. Now we have to take that $300,000 and subtract the preferred dividends. We said that since it's 6% on the preferred dividends are going to be $60,000. 6% times $100 par is $6 times 10,000 shares is 60,000. So 300,000 minus 60,000 means that our net income after preferred dividends is 240,000. So we need to take the 240 and divide by the number of shares. So how did we get this 285? Well, from January until March 31st, so January, February, March, 3 months, we had the 200,000 shares that we had initially been given. However, they said that as of April 1st, they had an additional shares of 50,000. So now from April until June, until the end of June, they had, instead of 200,000, they had 250,000 shares. So we need to give those 250 a different weight. So that's 3 months, April, May, June. So that's 3 months. So the weighted shares they had for January through March, 50,000. The weighted shares they had from April through June, 62,500. Well, then lo and behold, on July 1, another 80,000 shares come into play. So 250 plus the 80 is the 330. and they are outstanding from July, August, and September, so 3 more months. It's kind of nice they made everything 3 months. So 3 months out of 12 times the 330 gives us a weighted average of shares of 82,500. And then finally, October 1st, another 30,000 shares come into play. So we go from 30,000 to 360,000. And so that goes 360,000 for 3 more months until the end of the year. When we add these up, our weighted average for the number of shares is 285,000 shares. And that's the bottom number we're going to use. So for the income from continuing operations, we calculated that as 300,000 minus 60,000. We calculated that as the 240 divided by the 285, and that gives us 84 cents per share. The discontinued operations, you just take that number and divide it by the same 285,000 shares, and that gives us 25 cents per share. Now for the net income, the total earnings per share for all of the net income, you can just add these up, 84 cents and 25 cents, and get the $1.09, or you can take the full amount, the 372,000 minus the 60,000, and then divide that, and that should give you the 109 also. So with this earnings per share problem, you see that earnings per share can get a little bit more complicated than when we have a simple earnings per share situation where we may not have any discontinued operations, we may not have any change in the number of shares. Those are pretty straightforward. But realistically, a lot of times companies do have these changes, and so we need to know how to account for them in the earnings per share since it's such a crucial number. Okay, I hope that was helpful.